Well, hello there and welcome back to Dukascopy TV. I'm Doireann Mc Dermott. Well, the sterling fell to its lowest level since July 2011 as Moody stripped it of its AAA rating. Well, today on the subject I have Christophe Klein, and he is head of FX here at EFG in Geneva. Welcome today.
Thank you.
So Christophe, what do you think of this, big drop in the sterling and of course of Moody's downgrade?
Well, since the beginning of this year, sterling has been moving lower quite rapidly against both the dollar and the euro. Compared to the previous period of stability that we've seen over the last 3 years, the recent fall may look substantial, but on a longer term basis, this is not the case. As a matter of fact, sterling fell by about 30% during the period between mid-07 and early 09. So the recent 5% decline hardly qualifies as a big drop. Regarding the downgrade, well, I think that the market already had it pretty much discounted. So now the question is, where do we go from there, and what could be the drivers of the move? In my opinion, the sterling will continue to move lower against both euro and dollars, and this for several reasons. The first reason is that sterling is still a little bit overvalued on conventional measures, such as the real exchange rate used by the BIS. At the moment, I think that the overvaluation is about 3%, which means that sterling is still a long way from being considered as cheap. The second reason is that the market is still not yet aggressively short sterling. The scope for sterling weakness would be limited if the market were already positioned for in anticipation of such an outcome, of such a fall. But over the last year, the market's attention has been pretty much focused on euro and dollar. So in my opinion, the positioning is not likely to be a big impediment to further sterling weakness. And finally, even though the UK growth has been very weak, policymakers would probably assume that it would have been even weaker had it not been for the effects of a lower currency. So, in my opinion, a continued down move in sterling might be seen as acceptable or even desirable by policymakers, as this would probably bring some more impetus to both manufacturing and exports, and hence would probably help and give a boost to growth.
And Mark Carney now, he is set to take over as Bank of England governor now in July. Now, one of his goals is actually to have a more flexible inflation target. In February, we saw that the Bank of England, in their report, they're actually already starting to go in that direction. Now, do you think this is the right approach to take?
Well, to be honest, I don't really think that the Bank of England has a choice, really. The fact that inflation is going to continue to run above target for some time is clearly established, as is the fact that a tighter monetary policy is not the appropriate answer. Given, on top of that, given the non-conventional measures that the Bank of England has been supporting, it is fairly obvious that a more flexible inflation target is needed. What we can say is that what Mr. Carney stated is basically something that the market had already started to see as almost inevitable.
And Christophe, Mark Carney has also called for a formal review of the monetary policy framework every 5 years. Now, what are your thoughts on this, and also what should we expect to see from Mark Carney?
I think that such a move may lead to a tweak to the Bank of England's remit that would more specifically and more explicitly, allow the central bank to be more flexible about the time it takes to actually reach the inflation target. I also think that forward-looking language is something that looks increasingly likely in the near future. Regarding other measures that we could potentially see, well, I can't think of much actually, because Mark Carney stated that he is looking for a more flexible inflation targeting regime. But this is very similar to what has been mapped out by the inflation report in February. And so the only real change that Mr. Carney may bring into the monetary policy space is probably a more formal acknowledgement of the flexibility of the framework. This would suggest that if we were to see some more downside shocks to growth in the UK, then the Bank of England would probably have more scope to support the economy, even if inflation is still high. As for the tools that would be favored, in my opinion, I still think that quantitative easing will be the favorite tool of policymakers. But we certainly cannot rule out the exploration of purchases aside from gilts, and also maybe forward-looking language, but with numerical thresholds, just like what the Fed announced a few months ago.
And in terms of a regime change, what risks could the UK actually be taking?
Well, first of all, we have to remember that inflation has been running above target persistently for about 6 years now. So clearly, risks have already been taken. It is true, though, that inflation expectations have been relatively tamed and stable, and so this has helped the Bank of England immensely by allowing them to cut rates aggressively. The key question, in my opinion, is whether a regime change could possibly destabilize inflation expectations, and in the future, what would be the response that policymakers could take if these expectations would shift abruptly higher. This is not my base case scenario. I think that an abrupt shift higher in expectations is pretty unlikely, but I do think that as time passes, there is a clear and increasing risk that agents start to view the Bank of England's attitude towards inflation as pretty asymmetric, hence causing expectations to drift higher.
Thank you very much, Christophe, for coming in today.
Thank you.
Well, viewers, that is it for right now. But do stay tuned to Dúchascopy TV. And of course, if you enjoyed this interview, then do have a look at our other interviews. And I also did an interview with EFG Asset Management on the big rotation recently. So do have a look at that. But for now, goodbye.